One of the first mistakes I personally made was not having a strategy in terms of investing. And when I break down strategy is long-term or short-term. Long-term is a good analogy would be index funds or mutual funds, putting that X amount of dollars into a mutual fund and let it grow for the next 10, 15, 20, 30 years, whatever number you have in mind. Short-term investing is buying a stock. As we saw in the COVID-19, a lot of stocks dropped to 52-week lows. People were buying into that stock, and then when the market was come back up, they was able to capitalize on a 20, 30, 40, 50% gain on that particular stock, and they sold and made that money instantly.
The first mistake that I really remember that I made, and I feel like a lot of people have this same or make this same mistake, is whenever I thought about the stock market, I looked at it just with the wrong mindset. I looked at it as if I spent $150 on a stock, that money was just gone, that I had spent that money. But it wasn't like I was going to a concert or buying food. I wasn't looking at the potential appreciation. I wasn't looking at the dividends. It never really dawned on me until later on that it's like, well, if I absolutely need that money, I can always get it back out. That money's not gone forever. In fact, there's a good chance that whatever money I put in the market, there's a very good chance that I could take even more money out. So having that mindset kept me out of the game for a really long time. Whenever I talk to people now, we'll talk about stocks or what stocks I recommend, what ETFs I recommend, and I'll explain one to them, and they'll be like, oh my God, that's this much, or that's $300, that's $400, I can't spend that much. And it's hard to get people's mind wrapped around that they're not necessarily spending that money. That's still, your money is still there. You're investing into a company or into an index of companies that is hopefully going to give you a return, and that money's hopefully going to go to work for you.
So one of the mistakes that I personally made was not reinvesting my dividends. And you get dividends from really two different ways. One, having an individual stock, or having a mutual fund or index fund where you put X amount of dollars into that fund, and each quarter or each month, depending on how the fund's set up, you get a monthly or quarterly dividend. So when I had early success on, I was getting those dividends back, I wasn't taking that money I made from dividends and reinvesting. I was going and spending it. So what I was doing was losing out on the beauty of compound interest, and my account wasn't growing. The only way it was growing was the additional money I would put in for that account, which I wasn't doing because I was spending my dividends I earned and the extra money.
The second thing for me is having that wrong mindset. I waited too long to get into the market. I'd always heard that there was a lot of risk, and I think I kind of sensationalized that risk before I really ever knew anything about the market. I ended up holding on to my money too long, and this was the issue with that. So I kept my money in a savings account, and I figured, well, if I'm scared to put it in the market because what if I lose it all, which is always a legitimate fear, but the chances of it is very low if you kind of know a little bit about it. But the problem is when you hold your money in a savings account, inflation is just kicking the absolute shit out of it. So what I mean is this. So my savings account at the time was with Wells Fargo. So for every $10,000 you have in a Wells Fargo savings account, the interest rate is 0.01%, meaning that you're only gaining $1 for every $10,000 you have in that savings account yearly. Inflation is historically on the USD has taken 1 to 2% of its value, meaning 1 to 2 cents every year is taken away from the US dollar. So for instance, what was bought in 1950 could buy a lot more than what, let's say, $20 could buy now. My biggest second issue was not putting my money in the market and making it work for me, or at least having a high yield interest rate savings account that would offset that inflation rate.
So one of the additional mistakes I made was following the crowd. And what I mean by that is pretty much like the peer pressure of investing. There's shows such as Mad Money with Jim Cramer. Robinhood has the 100 top popular. There's different websites. If you Google top 5 dividend stocks to purchase, there's different companies that are endorsed or get a kickback from companies. And just this is an example, this isn't an exact company, GE or Verizon or Amazon. The list goes on and on, where they may reach out to a certain editor or publisher and say, hey, we'll give you X amount of dollars if you mention our stocks. Meaning those prices, the profitability of those stocks may be inflated because everyone is purchasing their stocks because they think Jim Cramer mentioned it on his show, then it's a must buy and everyone flocks to those stocks. And the reality is you have to do your own research. You have to understand the basics financials of that company. Is it a good company? Is that company going to be around the next 5-10 years? Does that company have a lot of debt? Do they have a lot of revenue, or they don't increase their revenue? Do they have a history of increasing their revenue, or have they lost money the past 5 years? Is it a company such as Kodak back in years ago was the company, but as digital cameras and cell phones come out, nobody knows about Kodak anymore. If you think about going to Walmart years ago with your little roll of film and you got it developed, no one does that anymore. So companies are susceptible of the rise and fall of just how technology, how we advance as a society. So be smart, don't follow the crowd when it comes to investing. Do your own research and make a good, educated decisions on your investment.
So to Pate's point, I think he brings up Kodak, and I think that's a great example of a company that didn't stay kind of on the forefront of innovation. In one of my recent videos, I did one on Nordic American tankers, and I caught some flack for why I didn't think the stock was going to appreciate. I bought into just like everybody, and I got FOMO from hearing all the Jim Cramers and everybody talking about it. But at the end of the day, where's the innovation at? So I think that's a great point that a lot of people, that's a mistake that a lot of people make, not even just beginners. There's plenty of savvy veteran investors that fall into that trench of just listening to the latest and greatest and not taking a step back, detaching themselves and looking at the whole picture and doing their research and understanding exactly what they're buying into. For my next one, I don't know if I would necessarily call it a mistake, but one of the things that I see a lot of people fall victim to is they just don't know where to get started. I remember I reached out to a brokerage company one time, and they said for me to even be able to walk in the door and speak to them, I had to come there with $25,000 ready to invest. I was in college. That wasn't possible. Whenever I wanted to start getting into the stock market, I just didn't know where to go, and so I started looking at these different online platforms, Thinkorswim with TD Ameritrade, and there are fantastic and phenomenal platforms out there, but the problem is for a beginning investor, that may not be the most appropriate platform. And for me, I would pull up these charts and I had no clue what the hell I was looking at. The information was overwhelming. It was just too much. It made you feel stupid. It was intimidating, and it was very, very easy just to be like, screw this. I'll just stay with my terrible savings account and call it a day. But then there was a thing called Robinhood. And with Robinhood, it got me in the game really quick. It's super user friendly, and it just kind of simplified everything for a beginning investor to kind of start dissecting. I started looking, when you start looking at the charts, it's nothing like a day trader's chart, but it can kind of show you the 5-year growth, 1-year growth. You go down a little bit farther, you see, okay, what is the dividend yield? What is the price to earnings ratio? And you start figuring these things out. And so Robinhood's gotten a lot of flack and a lot of hate, but typically they get hate from the people they're already these savvy and veteran investors. And to be honest, Robinhood may not be the platform for them. They may need to be on a completely different plane and with something way more advanced, because for a lot of us that are brand new to the market, or we just want to start seeing, we want to make money too, it's probably the perfect thing for us. And the reason Robinhood, just on a side note, got so much flack is because their system went down, and it happened to go down on one of the biggest trading days ever, and so they just got crushed. But if you want to know the truth, every online platform, every single one, has went down on multiple days. It's just Robinhood happened to go down on the worst day to go down on. So I can't necessarily that it was, like I said, I can't necessarily say that it was a mistake that I made. It was just I didn't know where to go to.
So one more mistake I made, and many people make, because there's countless books, there's countless articles on this, is the failure to diversify. Now, if you look at someone like Warren Buffett, they talk about they don't diversify because they say you should understand the company and make a calculated, educated decision. However, as a new investor, you just simply don't have the time, the resources, or the experience on making those decisions. So being able to diversify in your investment does several things. First thing it does, it allows you to have a little bit of peace. It takes the anxiety, takes the stress out of making investments and losing all your money. Basically, you're not putting all your eggs in one basket. The second thing it does, it allows you to understand each company. So if I take a little bit of money, I invest into a tech company such as Apple. I know Apple is going to be around for a while. Everyone has an iPhone. I have an iPhone. I'm purchasing the Apple. But at the same time, I want a consumer product such as Coca-Cola or Pepsi. I don't foresee Coca-Cola or Pepsi for going under in the next 5-10 years. They're a staple brand, not only in the United States, but in the world as well. So I don't put a little money into Coke or Pepsi, and then I want to do a little money into the energy sector. I could dabble into Exxon, BP, Chevron, etc. The purpose is, and the reason why you diversify is because historically when one company goes down, the other company's up. Meaning, I don't think of any time ever in the history of investing or stock market where every index, every market, every commodity, every sector has been completely flat. If you look in the Great Recession, while there were certain sectors that were down, they were certain sectors, people were still making money in the Great Depression. So the point is do not put all your eggs in one basket. If you're nervous about investing in single stocks, index funds, ETFs, mutual funds are a great way to put your money in there and let someone that's maybe a little smarter or someone that has more time to do the calculated investments so you get the most bang for your buck. Or if you know a little bit about the market and you want to dabble a little bit and research individual companies, don't put all your money in Amazon. Put a little money in Amazon. Put a little money in your energies, your healthcare, your consumer products such as like Coke or a food product, Johnson & Johnson. There's a variety of companies to scatter your money out so you get the best opportunity to make a little money and get that high return.
When I finally got on that Robinhood train, I felt like I was just picking stocks at random. And not only did I not research the companies, I didn't know how to research the companies. I didn't know what numbers told me value. I didn't know what numbers would tell me volatility. I didn't understand what a payout ratio was or dividend yield. I was just picking stocks completely pretty much at random. Once I figured out what a dividend is, I went to Robinhood, found the highest dividend that I could, and just put money in it kind of blindly, not understanding that the payout ratio was 300%. But then I started figuring out that, okay, if I'm going to actually make money in this thing and not lose my ass on it, I'm going to have to learn how to read a balance sheet. If I'm going to pick individual stocks, I got to learn how to read a balance sheet. I've got to understand what a price to earnings ratio is. I've got to be able to calculate a company's assets and debts. What's that ratio? Whenever I need to understand a REIT as opposed to an MLP or an ETF or etc. I had never even heard of a balance sheet until I started looking at the stock market, but I quickly started to understand and realize that I was going to have to learn how to read these numbers and understand this stuff. Really understand it, not just look at it and say I understood it, but really understand what I'm looking at and where I'm putting my money into. I started reading books, invested, stuff with David Ramsey and Warren Buffett, Charlie Munger, all these people. I started watching endless YouTube videos, such as we're making right now, on stock markets on companies, and how to look at that balance sheet and how to read it and make sense of it. So whenever I say that I made a mistake in not researching the companies, yeah, that was a mistake. But the biggest mistake was not understanding how to research the companies. Until you understand what those numbers mean in that balance sheet, you can research all day long and never understand anything what you're looking at.
And lastly, make sure you hit that like button. Do us a favor. It really helps the channel out. Lets us know that you like the video. If you have any comments, please put them in the comment section to help us out. And as always, hit that subscribe button to help the channel out as well.